The Dog Games R Us company is in the process of constructing a new building to house its operations and is considering the purchase of new, state-of-the-art pieces of machinery that will allow it to make dog games using less plastic. The owner of the business, Mr. I. M. Shaggy, wants to learn all he can about long-term operating assets before committing the company to this purchase. An asset is something of value that a business owns. Assets can be classified as either current or long-term. To be considered long-term, assets must provide future benefit to a business for more than the next 365 days, or the current year, will be used in the business and are not purchased with the intention of selling them to consumers. Operating assets are acquired to produce income for a business. Long-term operating assets are classified as tangible or intangible. Tangible assets have physical substance, and intangible assets are those that cannot be touched or felt. Examples of tangible assets include property, plant and equipment, and natural resources. A patent is an example of an intangible asset. A patent granted by a government authority provides an inventor with the exclusive right to use, produce, or sell his or her invention for a specified period of time. Let's look at a few more examples of tangible assets. Property, plant, and equipment. This category of tangible assets includes items like machinery, equipment, buildings, company vehicles, and land. All of these assets, except for land, get used up as they are being used to generate revenue for the company. In order to satisfy the matching principle, the cost of using the asset must be recorded in the same financial period as the revenue that it helped to earn. In accounting, the process of allocating the cost of property, plant, and equipment assets as they are used to earn revenue is known as depreciation. Land is not subject to depreciation as it has an infinite life, and its cost cannot be allocated to a particular time period. When a company acquires an asset, the amount it records on the balance sheet, which summarizes assets, liabilities, and shareholders' equity, is known as historical cost. Historical cost reflects purchase price of the asset plus all costs incurred to get the asset ready for its intended use. In the case of the Dog Games R Us company, the cost of the new building would include architectural fees for the drawings, the cost of building permits, and the cost to construct the new building. If Dog Games R Us decides to purchase the new equipment, the cost could include transportation charges to get the piece of equipment to the company's premises, costs incurred to upgrade wiring to accommodate the new piece of machinery, and the costs incurred to build a base for the new piece of equipment to rest on in the factory. Natural resources. Natural resources include standing timber and underground deposits of gas, oil, and minerals. These type of assets are physically extracted in operations, such as mining or cutting, and they are usually replaceable only by an act of nature. The cost basis for a natural resource is the cash or cash equivalent price of acquiring the resource and costs incurred in preparing it for its intended use. If the deposit on the property has already been discovered, then the cost basis becomes the price that the company paid for the property. The process of allocating the cost of natural resources over the periods in which they are used to generate revenue is known as depletion. The amount of depletion recognized on an annual basis is affected by how much of the resource is extracted, the residual value of the natural resource, what it will be worth when the extraction process is completed, and the cost of any future removal or restoration costs. Intangible assets, such as patents and trademarks, have characteristics similar to those of tangible assets. For example, they provide benefits to the company for more than one period. Let's assume that Dog Games R Us has received a patent for its game design. On an annual basis, the company would record amortization to allocate the cost of an intangible asset in the same period as the revenue it is used to earn. Amortization is the same concept as depreciation, but it is only used for intangible assets. The amortization period for intangible assets is the shorter of their legal lives or their useful lives. Once an asset is put into service, there are periodic costs that a company incurs to keep the asset in good working order. For example, a piece of machinery requires annual maintenance to replace parts that are worn out as it is used to produce, and oil needs to be changed in the company vehicles. The costs incurred to maintain assets are known as revenue expenditures, and they are expensed in the year they are incurred. They are not added to the cost of the asset as they do not lengthen its useful life. If a company were to incur an expenditure to make an asset last longer, then this cost would be added to the cost of the asset and depreciated over its useful life. This type of an expenditure is known as a capital expenditure. Long-term operating assets are acquired and used by a company to generate revenue over a number of years. These assets are classified as either tangible or intangible, and the cost to acquire them is the purchase price plus all costs necessary to get the asset ready for its intended use by the company. Tangible assets are those assets that have physical substance, such as a building or a piece of equipment. Intangible assets cannot be touched or felt. Examples include patents and trademarks.
Are you at work? Good. Look around your company. Chances are you see plenty of people. Now snap your fingers and make them disappear. In fact, go ahead and snap your fingers again to make all the raw materials disappear. And once more to make the electricity that powers your machinery go away. Feel free to leave the lights on, however. What you're left with are all the machines, land, equipment, and buildings used to produce your goods. In short, these are called plant assets. Technically speaking, anything that's used to make money that has both a useful life of more than a year and doesn't directly become part of the product itself is a plant asset. In this lesson, we'll look at examples of plant assets, as well as how accounting for them requires special attention. Like I said earlier, if you take a look around your company and remove all of the people and raw materials, you'll have a pretty good idea of what plant assets consist of. Specifically, these assets include all the machines, computers, buildings, and even land owned and used by the company. However, it's not only these physical items that you can touch. Let's say that you have an agreement to rent a location, but as part of the lease agreement, you can make improvements as you see fit to carry out your business, an arrangement called a leasehold improvement agreement. Unless the lease expires, which would cause the ownership of said improvements to revert to the owner of the building, you get to count those improvements toward your plant assets as well. In fact, even sites that are currently under construction for your company can be considered plant assets. In other words, there are quite a number of categories to which the term plant asset could apply, which brings us to the question, how are plant assets accounted for? Typically, in business accounting, an entry appears as a cost when it's manufactured and then disappears when it's sold. Hopefully, that cost is replaced by income and some level of profit. However, plant assets don't work that way. Instead, they're purchased, which is a cost, but then get an amount of depreciation every year that they're expected to remain useful. Depreciation is an accounting method used to show that a particular plant asset is in use and is actively benefiting the company. Depreciation is often tricky to conceptually understand, so let's put it this way. If you didn't have a truck to deliver your goods to customers, you'd have to rent one from someone. Depreciation in accounting is a numerical way to pay rent to yourself on that truck by assigning a good's value as an asset to the company. In this lesson, we learned about plant assets. Remember that plant assets are those parts of a company that serve the firm, are not employees, and can last for more than a year. Land, equipment, trucks, and even construction sites all count as plant assets, as may leasehold improvements, which is an arrangement in which you have an agreement to rent a location, but as part of the lease agreement, you can make improvements as you see fit to carry out your business. However, accounting for plant assets must be sure to include depreciation, which is an accounting method used to show that a particular plant asset is in use and is actively benefiting the company, and thus the accounting equivalent of rent paid to a company for having bought the plant asset in the first place.
You have volunteered to buy prizes for the school's fun fair, and your budget is $100. The principal indicates that you will be reimbursed when you provide receipts for the items you purchased. You decide to go to the dollar store, but when you get there, you learn that the store is under new management and nothing has been priced yet. You can't possibly get a receipt for what you're purchasing if you don't know how much anything costs. Buying and recording a plant asset works basically the same way. You must be able to reliably determine the cost of the asset before it can be recorded in your business's financial statements. Plant assets typically include larger items such as buildings, equipment, machinery, and land. These assets are items that will provide an economic benefit for a number of years. When one purchases a plant asset, the cost of the item must be determined before the transaction can be recorded. Cost is measured in one of two ways: using the cash paid for the item if it was a cash transaction, or determining the cash equivalent price that is equal to either the fair market value, or FMV, the price that a seller could get in the marketplace, of the asset given up, or in cases where this value is not easy to determine, the fair market value of the asset received. Generally, the amount paid for any asset, something that you own that has value, represents the historical cost, or the amount on an invoice, or market value if the asset was transferred into the business by one of the owners or through the purchase of another business. The rules of GAAP insist on the cost principle. That is, the amount paid for an asset will always be its value on the company books. This value can only be revised downward if the asset is significantly impaired. It does not go up because of inflation or increased market values. Capital expenditures are those expenses incurred for a capital asset that will extend the length of time that the asset is able to be used, its useful life. This includes all expenses to acquire an asset and make it ready for its intended use. The process of adding expenses to a plant asset is known as capitalizing. Examples of costs that would be added to a plant asset include freight, installation costs, and taxes. These are added to the cost of the plant asset, depreciated over its useful life, and not expensed in the current year. For example, let's assume that a company purchased a new piece of equipment worth $400,000 for its plant. Additional costs included $10,000 for transportation to get the piece of equipment to the plant, and $7,500 to construct a special base for the piece of equipment to rest on. Since the transportation cost and the cost of the special base are necessary to get the piece of equipment ready for its intended use, they must be added to the cost of the asset. Therefore, the cost of the equipment recorded on the balance sheet, which captures assets, liabilities, and shareholders' equity, would be $417,500, or the purchase price plus freight costs plus the cost to construct the base, $400,000 plus $10,000 plus $7,500. Revenue expenditures represent expenditures for ordinary repairs and maintenance. The assumption is that the benefit from the expense incurred will be used up in the current period, i.e. the expenses will not extend how long the asset will last. Examples of revenue expenditures include things like annual insurance and oil changes on a company vehicle. Revenue expenditures are charged directly to an expense account in the year they are incurred. For example, let's assume that the annual insurance on a company vehicle amounted to $1,500, and it costs $500 for quarterly maintenance on it. Should these costs be capitalized or expensed? These costs would be expensed because they won't provide an economic benefit that lasts longer than the current period. A basket purchase refers to when one price is paid for a number of assets. The cost of the basket purchase needs to be allocated to each individual item so it can be properly recorded on the company's balance sheet. The total purchase price is allocated to each individual item based on the relative fair market value, or FMV, of each item. For example, let's assume DMS Company paid $40,000 to buy a building and some land. The land was recently appraised at $20,000 and the building was appraised at $30,000. We will now calculate the cost of each asset purchased. At some point in an asset's useful life, a company may become aware that the equipment no longer has the same value, which can happen due to a number of factors, like wear and tear over time or change in technology. When an item's value is determined to be permanently impaired, the value will not come back, one must consider if the original cost can be recovered via future use or sale. If the original value cannot be recovered, then the asset must be written down to its net realizable value, or NRV. The company will recognize a loss on the write-down, which will decrease its net income for the period. Under International Financial Reporting Standards, or IFRS, the cost of an asset can be increased in certain circumstances and is meant to ensure that the value of the asset does not differ significantly from its fair value at the date at which the financial statements are being prepared. Property, plant, and equipment assets are subject to depreciation, that is, the allocation of the cost of the asset over its useful life rather than only at the time of purchase. There is a cost associated with using a plant asset to earn revenue. Recording depreciation on an annual basis ensures that the cost of generating the revenue is recorded in the same period as the revenue itself. Depreciation is an expense that will reduce a company's net income. Depreciation does not apply to land because its useful life is infinite. The cost of an asset includes all the costs involved with acquiring the asset and getting it ready for its intended use. The cost of a plant asset can only be recorded when it can be reliably measured. Imagine your friend Ella is about to open a new pet grooming shop. Ella begins to brainstorm all the items she needs to purchase for her new shop. Ella's list looks something like this: dog treats, cat treats, dog hair bows, leashes, and pet shampoo and fragrance. So far, Ella has a good list. These items will surely help, but what about the long life resources she will need in order to have continuous operations? These owned resources are called property, plant, and equipment. Property, plant, and equipment are considered long-term tangible assets because they should benefit the business for more than 1 year. The purchases of property, plant, and equipment could be Ella's biggest and most important decisions related to her new pet grooming shop. Let's go over examples and discuss more reasons why property, plant, and equipment are so important for the operation of a business. Land purchased for a business is an example of property. In the above example, Ella may want to purchase enough land to allow for a building and a small dog park area. The dog park will be a nice, secure place for the animals visiting her shop to walk around before or after their appointment. While considering property, Ella must take into account the location and the price. As you can see, this purchase is very important for the success of Ella's shop, and it should benefit her business for many years. Examples of plant include a building acquired to house a business, a storage building used to store inventory, and any other building purchased by the business to help provide continuous operation. In our dog grooming example, Ella will need to purchase or construct a building to house her shop. She must consider the type, size, and price of the building. This decision is very important as it will likely be her most expensive purchase. Like property, plant is also tangible and will benefit the business for more than 1 year. Looking over her list, Ella realizes she forgot about the equipment needed to provide an awesome grooming experience. She will need special fur drying machines, tools for shearing, a cash register, and a computer to keep track of her appointments and customer information. These are all examples of equipment. Ella should do research on the types and brands of equipment she will need. She should consider equipment with high quality and fair prices. Equipment must be tangible, and it should benefit the business for, you guessed it, over a year. So how does Ella record the acquisition of property, plant, and equipment? Well, company assets and liabilities appear on the company's balance sheet. Long-term assets, including property, plant, and equipment, should be listed below current assets. When preparing the general journal entry, the asset amount recorded should include the purchase price, transportation cost, installation cost, and any other charge incurred while putting the asset into use. Next, the same amount should be recorded in the cash account if cash was paid for the asset, or the correct long-term liability account. Long-term liability accounts, including mortgage payable, are for business debts that are due in more than 1 year. Depreciation, which will be covered in another lesson, must also be recorded each year for plant and equipment. Let's look at an example of a journal entry for land acquisition. Ella purchases 2 acres of land for her new shop. The purchase price is $25,000. She paid in full using cash. Here is what she would enter. Debit the land account for $25,000. Credit the cash account for $25,000. Property, plant, and equipment are listed as long-term assets on the company balance sheet. These assets must be tangible and they must benefit the business for more than 1 year. The purchases of property, plant, and equipment will likely be the most important purchases made by a company. These assets or owned resources will allow the business to have continuous operations. The total amount recorded for the acquisition of property, plant, and equipment should include the purchase price, transportation costs, installation costs, and any other charge incurred while putting the asset into use.
Almost everything we see around us has a useful life because it is being used up little by little every day or will become outdated as technology changes. Think about the computer you are using. You probably expect it to last only about 5 years because every time you access it, the components inside it get used up a little bit, and improved technology will eventually make it obsolete. This using up is called depreciation, and that 5 years is considered the computer's useful life. The useful life of an item or assets depends upon the type of asset or its property class, which can be determined through industry experience, personal experience, or by consulting Internal Revenue Service Publication 946, which provides a list of property classes and their useful lives. As assets depreciate during their useful life, they lose some of their value. For example, the furniture you bought for $1,500 5 years ago may only be worth about $500 today. People have been sitting in the chairs or on the couch, the table has scuff marks, and the fabric on the chairs isn't as bright as it was when you first bought them. No one would pay $1,500 for the furniture now. It has lost some of its value. To compensate for this loss of value caused by depreciation, businesses may write off some of the depreciation of long-lasting assets as an expense every year until the item reaches the end of its useful life. This is called residual value. It's what an item is worth at the end of its lease. For example, if you leased a car for 4 years and decided you wanted to purchase the car, the residual value would be what the car is worth now after the lease has expired and with all of the wear and tear that occurred during the lease. Long-lasting assets are things like machinery, vehicles, office furniture, and other items that are not used up quickly, excluding land. Land can never be depreciated because it does not wear out. There are many ways to calculate depreciation, but the 3 most common methods are straight line method, unit of production method, double declining balance method. To calculate depreciation, you need to know the item's useful life or total possible output, its costs including taxes, shipping, and preparation and setup expenses, and its residual value. For the unit of production method, you will also need to know how many units were produced for the production run. Straight line is the simplest depreciation method and involves allocating an even rate of depreciation every year for the life of the asset. You calculate annual straight line depreciation as follows. Annual depreciation expense equals asset cost minus residual value over useful life of the asset. Example, ABC Company purchases a truck for $20,000. It has a useful life of 5 years and a residual value of $3,000. Annual depreciation expense equals $20,000 minus $3,000 over 5 equals $3,400. Thus, ABC Company can take $3,400 in depreciation expense every year for the next 5 years. Unit of production depreciation is a 2-step process used to calculate depreciation for assets whose useful life is measured in output capability rather than years. Calculated as follows. Step 1. Determine depreciation per unit like this. Per unit depreciation equals asset cost minus residual value over useful life in units of production. Step 2. Figure out the total depreciation of the units actually produced. Total depreciation expense equals per unit depreciation times units produced. Example, XYZ Company purchases a flyer printing press for $50,000 with a useful life of 200,000 units and a residual value of $5,000. It runs a job of 5,000 flyers. Step 1. Figure depreciation expense for each flyer produced. Per unit depreciation, $50,000 minus $5,000 over 200,000 equals $0.225. Step 2. Determine the total depreciation for all 5,000 flyers. Total depreciation expense equals $0.225 times 5,000 flyers equals $1,125. Once you've figured out the per unit depreciation, you can apply it to future output runs. Example, the same press runs 2 more jobs, one of 10,000 flyers and a second one of 1,800 flyers. Job 1 depreciation expense equals $0.225 times 10,000 equals $2,250. Job 2 depreciation expense equals $0.225 times 1,800 equals $405. Double declining balance depreciation is a form of depreciation, but only at an accelerated rate. Keep in mind that this does not mean there will be more depreciation than any other type of depreciation over the life of the asset. It simply means that depreciation will occur at a faster rate in the beginning years and slow down towards the end of the life of the asset. The depreciation total is the same for both double declining depreciation and straight line depreciation. The difference is just when the depreciation occurs. Let's go over the calculation process. Step 1. Calculate the percentage of depreciation you could take every year for the duration of the asset's useful life. 100 over useful life in years equals annual percent of depreciation. Step 2. Double the percentage that you calculated in the first step. Annual percent of depreciation times 2 equals double depreciation percent. Step 3. Multiply the asset's book value by the double depreciation percent to get the current year depreciation. In the first year, the book value is the same as its cost. Asset book value times double depreciation percent equals current year depreciation. Step 4. Subtract the current year depreciation from the book value of the asset. The result will be used as the new book value used to calculate depreciation for the next year. Book value of asset minus current year depreciation. Example, ABC Company bought a tractor with a 3-year useful life and a $2,000 residual value for $30,000. Step 1. 100 over 3 equals 33.33% annual depreciation. This is the straight line depreciation. Step 2. 33.33% times 2 equals 66.66%, double depreciation. Step 3. $30,000 times 66.66% equals $19,998 depreciation. Step 4. $30,000 minus $19,998 equals $10,002, new book value. Step 5. 66.66% times $10,002 equals $6,667.33. Repeat steps 3 and 4 until you reach the final year, then subtract the residual value from the remaining book value to get the final year depreciation. Depreciation allows a business to write off the loss it experiences through the wearing down of assets. There are many ways of figuring depreciation, but the straight line method is the simplest and the most popular. Generally, depreciation is calculated using the asset's cost, residual value, and useful life.
You are a designer and you have a little design company. What you do is you make unique designs for the home and you print them out using a 3D printer. These printers let you print 3D objects using different materials. Yes, these printers print in space, starting from the bottom and working their way up. You can print vases, cups, and whatever other objects you can think of, as long as it is one continuous piece and not two separate pieces. These printers open up a whole new creative world to explore. As part of your business, you use a 3D printer on a daily basis to print out new designs and orders from customers. You bought this printer for $20,000. It has a life expectancy of 10 years, and it is expected to print about 150,000 3D items in its life. Rather than take the whole $20,000 expense at once, accounting rules allow you to allocate or spread the cost of an asset over its useful life. This concept is called depreciation. It will allow you to take part of that $20,000 as expense each year while the printer is making money for you. There are 3 ways you can go about calculating depreciation. The first and most basic is the straight line depreciation. This method is used when you use the printer the same amount each year. This is when you calculate the depreciation based on the life expectancy years. What you do is you divide the cost of the printer by the number of years of its life expectancy. This number then gives you the yearly depreciation of the printer. For your 3D printer, you take $20,000 and divide it by 10. You get $2,000. So every year you calculate a $2,000 depreciation amount for this printer. If you take a depreciation of $2,000 for the first year, the value of the printer drops to $20,000 minus $2,000 or $18,000. Claiming another $2,000 depreciation for year 2 drops the value of the printer to $18,000 minus $2,000 or $16,000 for the year after that. You keep going until the value reaches 0. Businesses can use other methods of depreciation as well. Accelerated methods allow more expenses to be taken in the early years of an asset's life. Businesses like these because they lower taxes in the early years. The most widely used accelerated method is double declining balance depreciation method. This method doubles the straight line depreciation percentage you take every year. For example, because your printer has a life expectancy of 10 years, each year you can claim 10% or 100% divided by 10 years of the cost of the printer. With the double declining balance method, you then take 20% of the current value of your printer each year. So the first year depreciation is $20,000, the current value, times 20%, or $4,000. For year 2, the current value is $20,000 minus $4,000, which equals $16,000. The depreciation for year 2 then is calculated to be $16,000 times 20%, which is $3,200. For year 3, the current value is $16,000 minus $3,200, which equals $12,800. The depreciation is $12,800 times 20%, which gives you $2,560. You keep going until your value reaches 0. The third method we're going to discuss is the units of production depreciation method. This method allocates the cost based on actual use. The printer can print 150,000 in its life, so the cost to print each item is $20,000 divided by 150,000, which equals 0.13333, or approximately 13 cents. Of course, this doesn't include the cost of materials used to print each item, but this cost is included in your financial reports elsewhere. Using this method, your depreciation is based on the number of items you print each year. So if in year 1 you print 10,000 items, then your depreciation for this year is 10,000 times 0.13, or $1,300. In year 2, if you print 20,000 items, your depreciation is 20,000 times 0.13, or $2,600. You keep going until the number of items reaches the number of items the printer is expected to produce in its life. These examples assume, however, that the company will own the printer until the end of its useful life. But what happens if in the middle of year 5 the printer breaks and is not worth the cost of repairing it? For that year, using straight-line depreciation, you would not be able to claim the entire $2,000 depreciation. Instead, your depreciation in year 5 would only be $1,000. Another consideration that would affect depreciation calculations would be its salvage value. Companies also sell tangible assets when they've reached the end of their useful life. In this case, the company may plan to sell off the printer at the end of its useful life to a company that buys and repairs out-of-date printers. For example, while the company paid $20,000 for the printer, at the end of its useful life, they can sell it off for $3,000. That $3,000 is its salvage value. Now, the total depreciation over the useful life of the printer would be $17,000. $20,000 minus $3,000 gives you $17,000. Now, the most the company can claim as depreciation is $1,700 per year, or $17,000 divided by 10, which gives you $1,700. Let's review what we've learned now. Depreciation allocates or spreads the cost of an asset over its useful life. We discussed 3 different ways to report this depreciation. The first is straight-line depreciation. Using this method assumes that you use the printer the same amount each year. To calculate this depreciation, you divide the cost of the printer by its life expectancy. The second method is the double declining balance depreciation method. This method is used to allocate more of an asset's cost to the early years of its life. Businesses use it for tax purposes. To calculate this depreciation, you double the percentage of your straight-line depreciation. The percentage of your straight-line depreciation is 100% divided by the life expectancy. Double this percentage to get the percentage for your double declining balance depreciation. Then your yearly depreciation is the current value of your item times the percentage. The third method, units of production depreciation, allocates costs based on the asset's actual use. This method divides the cost of the machine by the number of items it can produce in its life. Then the depreciation each year is calculated by multiplying the number of items printed that year by the cost per item. Partial year depreciation would occur when the asset is not in use for the full year. To calculate that, the annual depreciation would be divided by the number of months the asset was in use. Also affecting depreciation is salvage value, or what an asset could be sold for at the end of its useful life. If there is a plan to sell the asset in the future, the salvage value would be estimated and deducted from the original cost of the asset. Depreciation would be based on that lower amount.
You own a small business selling flower arrangements to people in your local neighborhood. You guarantee same-day delivery for purchases made before 10 a.m. You can do this because you own your own delivery vehicle and you have an employee that makes all the deliveries for you. Another year has passed, and it is time again to do your yearly taxes. Of course, you don't want to pay more taxes than you have to, and you want to make sure your taxes are filed accurately. One of the provisions that the government gives businesses is that you can take depreciation on your business vehicle. Depreciation is the value lost each year that you own a particular item. Cars, for example, lose value every year. For example, if you buy a car for $24,000, you can't sell it for $24,000 because as soon as you've used the car, it starts to lose value. With each passing year, your car is worth less and less. Because of this loss in value, the government allows you, a business owner, to claim this loss on your taxes, so you don't have to pay taxes for this loss for your business. Taxes are complicated, and there are charts that you need to refer to so that your depreciation calculations are correct. For the sake of this video lesson, though, we will make just a sample depreciation calculation. Don't rely on this calculation, though, to calculate your own taxes. So, let's do a sample calculation for the depreciation of the delivery vehicle for your flower business. Say you bought the vehicle brand new the year before November for $40,000. The vehicle has an estimated life of 10 years. You plan on keeping the vehicle for the life of the vehicle, so your depreciation is based on this life of 10 years. At the end of the 10 years, your vehicle is considered to have a value of $0. Based on this information, you divide the $40,000, the original value of the vehicle, by 10 years, the life of the vehicle, to calculate the per year depreciation of this vehicle. $40,000 divided by 10 is $4,000. So each year you can claim a depreciation loss of $4,000 for this vehicle if you've owned the vehicle for the whole year. This means that if you've owned the vehicle for just part of the year, then you can't claim the full $4,000 for the depreciation. You would need to calculate the partial year depreciation, the depreciation for an item used just part of the year. For example, the previous year you owned the vehicle for just 2 months, November and December. To calculate the amount of depreciation for just these 2 months, we take the full year depreciation divided by the number of months in a year, 12, and then multiply it by the number of months we've owned the item for. So, for your vehicle, since you owned it for just 2 months that year, you would take $4,000, the depreciation for the full year, divided by 12, and then multiply it by 2. Doing that, you get $666.67 for this year's partial year depreciation. Now, if, for whatever reason, the value of your vehicle changes the year that you do your taxes, your depreciation calculations will change. Your depreciation for that year and the following years will also change. This change in value is referred to as a change in estimate. So say, for example, that 5 years after you've owned the vehicle, the current value of the vehicle suddenly increases by $2,000 with a life expectancy left of 5 years. You would need to account for that in your depreciation calculations. To calculate this, you need to make depreciation calculations on this increase and then add it, since it's an increase, to the depreciation that you've already calculated. So we take our increase of $2,000 and divide it by the remaining life, 5 years. We get $400. So this means that we can claim an extra $400 in addition to our $4,000 for the depreciation of the vehicle this year, since we've owned the vehicle for the full year. So our depreciation for year 5 is $4,400. If our change in estimate is a decrease, then our depreciation calculations will also decrease. Let's review what we've learned now. Depreciation is a value lost each year that you own a particular item. This is something that you calculate on your taxes if you are a business owner. To calculate the depreciation, you take the original cost of the item and divide it by the estimated life of the item. This calculation gives you the full year depreciation. If you only own the item for part of the year, then you will need to make a partial year depreciation calculation. To make this calculation, you take your full year depreciation, divide it by the number of months in a year, and then multiply it by the number of months you've owned the item. If there is a change in estimate, a change in value or other, then you will need to make the depreciation calculations to this change, and then add or subtract it from your original depreciation calculations as needed. You own a landscaping company where people come to you to design their yards. You have the experience and the creative talent to design the best-looking yards anyone has ever seen. You have received many top landscaper awards over the years and have a waiting list of customers. You are certainly not hurting for money. Because a company is so successful, you have a number of company assets, equipment that is used in business. Part of your assets include a rather large fleet of landscaper trucks. You purchased the top line of trucks for your company and had your company logo and information painted on the trucks. You purchased these trucks for $60,000 each. You are planning on keeping these trucks for their whole life expectancy of 10 years. You know, though, as the trucks age and as you use them, they begin to lose value. Each year they lose a bit more money and their value drops. As part of your financial reporting, you report this drop in value as your depreciation. The easiest method to report your depreciation is called the straight-line depreciation method. This method divides the cost of your truck by the number of years it is expected to be used, life expectancy. This number then gives you your annual depreciation. To calculate the monthly depreciation, you then divide the annual depreciation by 12, the number of months in a year. So our trucks have a yearly depreciation of $60,000 divided by 10, or $6,000. Each month the depreciation is $500. This means that each month the truck's value drops by $500 and each year the truck's value drops by $6,000. So in year 2, the value of the truck is $60,000 minus $6,000, or $54,000. Year 3, the truck's value is $54,000 minus $6,000, or $48,000. As part of accurate reporting and financial bookkeeping, you report the depreciation in 2 places. The first place is in the balance sheet, the statement of what the company owns and owes. The balance sheet gives an overview of what the company is worth and what kind of debt the company is in. As far as our depreciation is concerned, the balance sheet gives you the total depreciation you have taken so far. So, the depreciation for one truck for year 1 of owning the truck is $6,000. For year 2, the depreciation will show $12,000, the total depreciation taken after 2 years. For example, if you purchase the truck in 2014, the depreciation will be $6,000 in 2015 and $12,000 in 2016. The next spot where you report your depreciation is in the income statement, a report of the income and expense of the company during a certain period. Because our income statement only covers a certain period, usually each month of each year, the amounts on the income statement will most likely differ from those on the balance sheet. The depreciation shown on our annual income statement for each year is $6,000 because each year we only take $6,000 depreciation for each truck. On our monthly income statement, our depreciation changes to $500 for each month. We don't write the accumulated depreciation on the income statement because it only covers a certain period and does not give a glimpse of the company's overall performance. The income statement gives a glimpse of what happens to the company during a certain period. Now you can move on to reporting other financial matters. Let's review what we've learned. A company's assets is any equipment that is used in business. This equipment loses value over time. This loss in value is reported as depreciation. This depreciation is reported in both the balance sheet, the statement of what the company owns and owes, and the income statement, a report of the income and expense of the company during a certain period. The balance sheet will show the total depreciation over time, while the income statement only shows the depreciation for the current period. These two numbers will most likely not be the same. Congratulations on starting your new widget company. Of course, before you will make the first penny off your widgets, you will have to make sure that your accounting practices are up to standards. After all, what's the point of making money if you don't know where it is going? Getting into the widget business has been an expensive endeavor. As a result, you've already got a stack of receipts for everything that you've had to buy. You did save those receipts, right? Okay, good. Anyway, you've got a big pile of receipts and are starting to put all of it together in order to make sure that your newly hired accountant isn't swamped with work. She said that as long as you can sort it between capital expenditures and revenue expenditures, that she'd be happy to do the rest. Luckily for you, that won't take much time at all. That's because you remember the basic difference between the two types of expenditures. Capital expenditures are any expense that comes from gaining the ability to produce a product or service, whereas revenue expenditures are expense that is involved in the actual manufacture of goods. Understanding what a capital expenditure is important because the rules of accounting let you treat capital expenditures differently. This is because the cost of capital expenditures can be spread out across accounting periods. Most obviously, you don't have to charge them all right away. After all, you'll be using these implements for quite some time if all goes as planned. Instead, capital expenditures are often filed as property, plant, and equipment. This comes with some significant advantages. For starters, you can spread out paying for these expenses over time. This is because they are considered to be assets, not inputs. Also, you can take a depreciation expense every year for anything that is a capital expenditure, except land. This is to make up for the fact that these assets are losing value. Still, not everything that you have purchased is a capital expenditure. There are many revenue expenditures still to be considered, like wages, supply costs, utilities, and repair costs. These costs are really only useful in that particular moment and have no further effective life. The wages that you pay your employees only really guarantee that they will come to work on days that you pay them. Sure, many of them may love working for your widget factory, but they aren't going to come in and work on Saturday for free. Likewise, paying your electric and water bills does not guarantee that there will be electricity and water without payment in the future. As such, it's best to clear these items off the ledger and match them with revenues from the same period. So, back to your widget factory. Chances are that when you built your widget factory, you didn't get it for free. All the construction costs of building the factory are considered capital expenditures. So too are all the costs with equipping the factory with what is needed to make widgets. All of that fancy machinery used to produce the best widgets around can be categorized as a capital expenditure. In fact, as long as you weren't having the workers bring their own tools, any tools that you provide can be considered to be capital expenditures. From earlier, you probably figured out that the electricity and water needed to make your widget factory work are revenue expenditures. So too are all the raw materials needed to make widgets. Whether it's just old-fashioned plastic or computer chips for smart widgets, anything that can be directly turned into a widget is a revenue expenditure. Think about it like this. If you were making a sandwich, the bread, mayonnaise, meat, cheese, and electricity to light the room would all be revenue expenditures, while the knife and plate would be capital expenditures. You consume the bread, mayonnaise, meat, cheese, and electricity in making the sandwich, but the knife and plate are reusable. So how does all that factor in on a balance sheet? Let's say that during the first quarter you sold your widgets for a total of $3 million. Your factory cost $40 million to set up, which is your capital expenditure. Meanwhile, all your revenue expenditures, the cost for actually producing the goods, was only $1 million. If you treated all those losses equally, it would look like you had lost $39 million in just 3 months. In other words, no one would want to invest in your company. However, by treating the setup costs as capital expenditures, you could spread that debt around. Since there are 4 quarters in a year and your factory has a useful life of 10 years, you could divide the $40 million by 40 for your quarterly capital expenditure cost, giving you $1 million. So now you have $3 million in profit minus $1 million each in revenue expenditures and $1 million in capital expenditures, which gives you a profit of $1 million. Suddenly, your factory is making $1 million a quarter. Now that is profit. In this lesson, we look at the difference between capital expenditures and revenue expenditures by looking at the operation of a widget factory. Capital expenditures are those expenditures that are made to secure the ability to provide goods or services. These expenditures do not form part of the good or service. For example, land, the physical building, and any equipment used to manufacture the goods in question are all purchased as capital expenditures. On the other hand, revenue expenditures are those costs that are justified by the revenue that they bring in immediately. These are most often used in the direct manufacture of a product, such as raw materials, wages, and electricity.
Your daughter's school is organizing a garage sale, and each child has been asked to provide 5 items for the fundraiser. She goes through her closet and presents you with 5 items. After reviewing the selections, you determine that 2 of the items are markers that have run out of ink, but the remaining 3 items would be suitable for the sale. Just like a garage sale, some assets, or things that a company owns, have value when they are disposed of, while others do not. Depending on the proceeds received, selling a capital asset can result in a gain or loss on disposal, or no impact at all. In order to determine if there is a gain or loss, the original cost of the capital asset and its accumulated depreciation, or the amount of depreciation taken on the asset since it was put into use by the company, must be known. If the proceeds received are greater than the net book value, the asset value less accumulated depreciation of the asset, then there is a gain on disposal. If the proceeds received are less than the net book value, then there is a loss on disposal. Let's assume that a vehicle that cost $30,000 with accumulated depreciation of $10,000 was sold for $25,000. The net book value of the vehicle was $20,000, $30,000 minus $10,000, and the proceeds received were $25,000, so there would be a gain of $5,000, $25,000 minus $20,000. The accounting entry would look like this. Now, let's assume that instead of receiving proceeds of $25,000, the company sold the car for only $15,000. The net book value of the vehicle would still be $20,000, $30,000 minus $10,000, and there would be a loss of $5,000, $15,000 minus $20,000. The accounting entry would look like this. An asset is usually retired because it is at the end of its useful life and cannot provide any more value to the company. The asset may have a net book value of 0, which suggests that it is fully depreciated, or it could have a net book value that is greater than 0. Let's assume that a piece of computer equipment that cost $25,000 to purchase was retired. The amount of depreciation taken on the computer equipment was also $25,000, which means the net book value is $0, $25,000 minus $25,000. Since the net book value is $0 and the company did not receive any proceeds upon disposal, there is no gain or loss for this transaction. However, an accounting entry is still necessary to take the computer equipment out of the asset account. The accounting entry would look like this. An asset that is being retired could also have a net book value that is greater than $0. In this case, the retirement of the asset would result in a gain or a loss to the company. Let's assume a vehicle that cost $20,000 and had accumulated depreciation of $17,000 was retired. The company did not receive any money for the vehicle at disposal, and the net book value was $3,000, $20,000 minus $17,000. Since the net book value is greater than the proceeds received, there's a loss of $3,000 upon the retirement of the vehicle. The accounting entry would look like this. Sometimes a company trades an existing asset for a newer asset. In these situations, the asset being traded still has some use and has a net book value that is greater than $0. A gain or loss on exchange could occur as a result of this transaction. Let's assume that a vehicle that cost $20,000 with accumulated depreciation of $15,000 and a net book value of $5,000, $20,000 minus $15,000, was traded for a new vehicle that cost $35,000. The dealership provided a trade-in allowance of $6,000 on the old vehicle, and the balance owed by the company was paid in cash. In this case, the company would record a gain on sale, since the proceeds received for the old vehicle, $6,000, were greater than the net book value of the old vehicle, $5,000. We would expect a $1,000 gain, $6,000 minus $5,000. The accounting entry would look like this. Assets are things that a company owns. Capital assets can be disposed of by sale, retirement, or exchange. Each of these transactions could result in a gain, a loss, or no impact to the company, depending on the net book value of the asset at disposal, which is the asset value less accumulated depreciation. Accumulated depreciation is the amount of depreciation taken on the asset since it was put into use by the company.
You should be familiar with the definition of an asset in a company and how to account for them on the balance sheet. However, you may not know how an asset such as land with minerals is handled in accounting. For this lesson, we will travel with Lydia, who is the owner of Profits Incorporated, as she goes into the business of purchasing land and selling the natural resources. For her first purchase, Lydia finds a plot of land that consists of 1,000 acres and is estimated to contain 600,000 tons of coal. She purchases the land through her company for a price of $300,000. When a company purchases a piece of machinery, the value of the machine decreases as it is used until it eventually reaches its salvage value. The salvage value is what the item is worth at the end of its useful life. The process of decreasing the value of equipment is called depreciation. Accepted accounting procedures allow many methods of depreciation, such as the straight line method, the double declining method, and the sum of years method. When the asset happens to involve land with an estimated amount of natural resources, the same concept of depreciation applies, but in this case, it is called depletion because the resources are being depleted, removed from the land. Depletion is also different because it does not depend on any length of time, but is directly related to the amount of resources removed. Depletion would be used when resources such as coal, precious metals, timber, or petroleum are to be extracted. When the land was purchased on October 11th by Profits Incorporated, the accountants created and debited the land account for $300,000 and credited the cash account for the same amount. At the end of the year, Profits Incorporated removed 100,000 tons of coal from the land. Lydia knows that the land is not worth the same amount now as when she purchased it, but she needs to figure out how much it is worth as she begins to prepare her taxes. Lydia knows she must follow 3 steps to make her calculations. First, she must divide the amount paid for the land by the estimated units of measure of the natural resource, in Lydia's case, tons. Second, the result of that computation will give you the price for each unit of measure, the price per ton for Lydia. Third, she must multiply the number of units of measure extracted by the cost for each unit. In this case, Lydia would divide the $300,000 she'd paid for the land by 600,000 tons of estimated coal to come up with 50 cents per ton. She would now multiply the 50 cents per ton times the number of tons removed, 100,000, to come up with a depletion amount of $50,000. Lydia can now update the value of her land by debiting the depletion expense account and crediting the accumulated depletion land account. The accumulated depletion land account is considered a contra-asset account and will offset the asset land on her balance sheet. A contra-asset account typically has a credit balance and is attached to an asset to give it its current value. Note that the asset account itself, land, still has a debit balance of $300,000, but its true value can only be found when taking the contra-asset account into consideration as well. The real value of the land account is the $300,000 minus its associated accumulated depletion account of $50,000 for an end-of-year value of $250,000. Here's a question for you. What is the value of the land Lydia purchased at the end of the second year after her company has removed another 250,000 tons of coal? Remember that we have already completed the first 2 steps of the process to figure out the cost per ton. Therefore, we only need to follow the last step. The amount used for each ton is still 50 cents, and we would just need to multiply that by the amount of tons extracted the second year. 50 cents times 250,000 tons equals $125,000. The $125,000 represents the amount of depletion expense for year 2. At the end of the year, Lydia would debit the depletion expense account for $125,000 and credit the accumulated depletion land account for the same amount. The balance in the accumulated depletion land account would be a credit balance of $175,000, $50,000 for year 1 and $125,000 for year 2. The land account does not change and still has a debit balance of $300,000. The value of the land is $300,000 minus the total accumulated depletion of $175,000 for a value at the end of year 2 of $125,000. If you were able to answer the previous question, congratulations. Here's another challenge for you. What if the original estimate for 600,000 tons of coal is wrong? At the end of year 2, Profits Incorporated has extracted a total of 350,000 tons. An expert states now that they have a better view of the site, they see only an estimated 200,000 tons remaining, instead of 250,000 tons they thought should be there. What should Lydia do? At this point, it is too late to adjust any of the previous year's expenses. The only thing that is left is to adjust the depletion amount based on the revised estimate. This means that we take the value calculated at the end of year 2, $125,000, and divide it by the remaining quantity of coal, 200,000 tons, and come up with a revised depletion rate. $125,000 divided by 200,000 tons is $0.625 per ton. Lydia would then use $0.625 as the base cost per ton in calculating the depletion expense for year 3. Depletion is the process of adjusting the value of a natural resource asset so that it accounts for the removal of the natural resources during the asset's life. Depletion differs from depreciation in that it is not linked to any length of time and changes based on the amount of resources removed. The 3 steps to compute depletion expense are 1. Divide the cost of the asset by the amount of natural resources it contains. 2. Determine the cost per unit. Then 3. Multiply the cost per unit times the number of units depleted, or removed, to determine the depletion expense for that year. The accumulated depletion account is a contra-asset account that contains the total depletion amount for the life of the asset, and must be subtracted from the asset's original debit balance in order to obtain the current asset value.
Liam is collecting information on his company's assets, both tangible and intangible. He needs a complete inventory and begins with tangible assets. These are assets that are physical in nature. Examples include land, equipment, machinery, vehicles, and stocks. Tangible assets are pretty straightforward. They are things we can see, hear, and touch. The company also has several intangible assets, which are assets that don't have any physical form to them and are somewhat difficult to value. Examples are goodwill, patents, and copyrights, which we'll take a look at right now. Goodwill is considered an intangible asset that includes customer base, brand recognition, and proprietary technology. For Liam to calculate the company's goodwill, he had to determine a company's fair value above its book value. Examples can include your company's reputation and its brand. Patents are time-sensitive licenses, usually 20 years, given by the U.S. Patent and Trademark Office to holders designating exclusive rights to a specific design or invention. Liam's company has a patent for creating a new type of caffeine-free coffee. Other examples of patents your company might obtain are utility, design, and plant patents. Copyrights are rights to intellectual properties that provide only the owner and whoever the owner gives permission to access to copy the property. Liam's company has a new jingle associated with its new coffee line, so this is a copyright he has to value. Additional examples of copyrights you're probably familiar with are software, art, and popular music. These intangible assets are either indefinite or definite. A company's brand recognition is associated with a company as long as the company is around, so it's considered indefinite, meaning that it's an asset that exists for a company as long as the company exists. A company like Nike is an example of this. When we see the swoosh, we automatically know it's a Nike product. We associate athletes, sports, and fitness with the brand, and will continue to do so as long as Nike and the swoosh exist. Brand recognition is something Liam can add to his intangible asset list under those that are categorized as indefinite. Definite intangible assets are assets that have a specific time period associated with them. Being granted a patent for 20 years by creating a new way to access natural gas is an example. This specific time frame makes the asset a definite intangible asset. Liam would need to document those intangible assets that hold value for a specific time period. Intangible assets are those assets that a company has that hold value but have no physical form. Tangible assets, on the other hand, are assets that are physical in nature, such as land, buildings, equipment, vehicles, and goods. Examples of intangible assets are goodwill, which is an intangible asset that includes customer base, brand recognition, and proprietary technology. Patents, which are time-sensitive licenses, usually 20 years, given by the U.S. Patent and Trademark Office to holders designating exclusive rights to a specific design or invention. And copyrights, which are rights to intellectual properties that provide only the owner and whoever the owner gives permission to access to copy the property. Intangible assets are defined as either definite or indefinite. Those assets that carry a value over an unspecified time period are considered indefinite. Assets that only hold value for a time period that is specified, such as 10 or 20 years, are considered definite intangible assets. Urban Sneaks is a shoe company that's been in business for 30 years, enjoying considerable success and is known for a high-quality product. Some of Urban Sneaks' equipment is getting quite old, and the owner of the company, Miss B. Shoe, is wondering if it's time to replace it. She needs a way to measure how efficient her equipment is in making money for her business. Since resources are finite, it's important for every business to use its assets, items that it owns, as efficiently as possible. Property, plant, and equipment assets are defined as large items, like machinery, equipment, and buildings, that a company uses to generate sales revenue. Since property, plant, and equipment assets usually represent a significant monetary investment for any company, it's important to determine whether or not the company is using these assets in an efficient manner to produce sales. The best way to measure the efficiency with which a company is using its property, plant, and equipment assets is to calculate the asset turnover ratio. The formula for the asset turnover ratio is net sales divided by average property, plant, and equipment assets. Let's assume that Urban Sneaks Company had property, plant, and equipment assets of $500,000 last year and $650,000 this year with net sales of $2,500,000 in the current year. The asset turnover ratio would be 4.35. $2,500,000 divided by $500,000 plus $650,000 divided by 2. A ratio of 4.35 means that the company generates $4.35 of sales for each dollar that it spends on property, plant, and equipment assets. Generally, the higher the ratio, the more efficiently the company is using its property, plant, and equipment assets to generate sales revenue. The asset turnover ratio should always be compared with the company's past performance, as well as other companies in the same industry. For example, Miss B. Shoe would want to compare this year's asset turnover ratio for Urban Sneaks to the prior year's results, and also to that of her largest competitor, Quality Shoes for You. The industry in which the company operates is important because different industries have different needs for property, plant, and equipment assets. For example, an insurance company would not need to spend as much money on property, plant, and equipment as a large airplane manufacturing company. There are several steps that a company can take to improve the efficiency with which it's using its property, plant, and equipment assets. For example, the company could review its current listing of property, plant, and equipment assets and identify those assets that are obsolete or no longer useful, and those which are underutilized or simply not used at all. Property, plant, and equipment assets that are not used to generate sales should be liquidated. In some cases, it may be better for a company to lease some of its assets to avoid problems with obsolescence. This strategy is useful when dealing with technology, as obsolescence occurs very quickly with these assets. Companies must ensure that their property, plant, and equipment assets are used in the most efficient manner possible. Calculating the asset turnover ratio and comparing it with information from prior years, as well as with its competitors' results, will assist a company in determining how efficient its property, plant, and equipment assets are in generating sales revenue for the company.
Meet Ron. He is an accountant, and he is here to help companies keep their financial documents in order. He is here at your printing company today to help you choose a depreciation method. Depreciation means you calculate the loss of value in your equipment. Whatever value is lost per year in your equipment, you can write in your financial reports and then transfer the appropriate amount to your year-end taxes. By doing this, you are taking into account that your equipment loses value each year, and that affects your company's bottom line. When your equipment loses value, your company loses money. The basic depreciation calculation assumes that the equipment is used steadily throughout its useful life. But sometimes you need to make accelerated depreciation calculations. This takes into account that some items depreciate more in the first few years of use, so your depreciation amount in these years are more than later years. There are two common accelerated depreciation methods. The first method that Ron is going to talk about is the doubling decline balance method. This method takes your basic depreciation percentage for the year and doubles it and multiplies it by the current value of your item. So for example, if you were depreciating one of your large printers that costs $120,000 with a life of 10 years, the basic depreciation percent per year is 100% divided by 10 years, or 10% per year. Multiplying $120,000, the value of the item for year 1, by 10%, or 0.1, gives an annual depreciation of $12,000 for your basic depreciation for year 1. The depreciation using the double declining balance method for the first year is $120,000 times 20%, or 0.2, double the percentage used for the basic depreciation calculation. This works out to be $24,000 for the first year. For year 2, the printer has then dropped in value by $24,000, since that is the depreciation you calculated the year before. Subtracting this from the original cost of $120,000 gives $96,000. Multiplying this $96,000 by 20% will give the depreciation for year 2. It is $96,000 times 0.2 equals $19,200. Keep doing this until you have depreciated your value down to 0. Let's look at another example. You also have this high-end scanner that you bought for $90,000. It has a lifetime of 5 years. Calculate the depreciation for the first 2 years using the double declining balance method. A lifetime of 5 years gives a basic depreciation of 20% per year, 100% divided by 5. Doubling this gives 40% per year for the double declining balance method. For year 1, the depreciation is $90,000 times 0.4 equals $36,000. For year 2, the value drops to $90,000 minus $36,000 equals $54,000. The depreciation for year 2 is $54,000 times 0.4 equals $21,600. Ron now goes on to tell you that there is another method that you can use to accelerate your depreciation the first few years. This method is called sum of years digits. Using this method, the depreciation percentage is greatest for year 1 and decreases each year based on the life of the item. Ron shows you an example using the same printer that you bought for $120,000 with a life of 10 years. This method is called the sum of the year's digits because you add up the years of life that the item has. 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9 plus 10. This gives you a total of 55. To calculate the depreciation percentage for each year, you divide each year by the total. So for year 1, the depreciation percentage is 10 divided by 55. For year 2, it is 9 divided by 55. For year 3, it is 8 divided by 55. And you keep going until you reach year 10 with a depreciation percentage of 1 over 55. Each year you multiply this percentage by the original cost of the item. So year 1 has a depreciation of 120,000 times 10 over 55 equals $21,818.18. Year 2 has a depreciation of $120,000 times 9 over 55 equals $19,636.36. Of course, like all depreciation methods, you keep going until you reach a depreciated value of 0. Let's go back to the scanner and calculate the depreciation using the sum of the year's digits for years 1 and 2. The scanner has a life of 5 years, so the sum of the year's digits is 1 plus 2 plus 3 plus 4 plus 5 equals 15. Year 1 has a depreciation percentage of 5 over 15. Year 2 has a depreciation percentage of 4 over 15. The cost of the scanner is $90,000. So the depreciation for year 1 is $90,000 times 5 over 15 equals $30,000. And year 2 is $90,000 times 4 over 15 equals $24,000. As you can see, the depreciation amounts are a bit different for each method. The method you choose depends on how much you want to depreciate the first few years, and also on how much more use you get out of the item in the first few years. Now let's review what we've learned. Depreciation means you calculate the loss of value in your equipment. Accelerated depreciation means you depreciate more in the first few years of use of an item. There are 2 common accelerated depreciation methods you can use. First is the double declining balance method. This method takes your basic depreciation percentage for the year and doubles it. You then take this percentage and multiply it by the current value of your item. For example, if an item has a life of 10 years, the basic depreciation percentage is 10%. The percentage using the double declining balance method is 20% per year. Each year you multiply the current depreciated value of the item by the percentage. The next method is the sum of the year's digits. Using this method, the depreciation percentage is greatest for year 1 and decreases each year based on the life of the item. To use this method, you add the years of the item. For example, an item with a life expectancy of 5 years has a sum of the year's digits of 1 plus 2 plus 3 plus 4 plus 5 equals 15. Year 1, then, has a depreciation percentage of 5 over 15. Year 2 has a depreciation percentage of 4 over 15. Year 3, 3 over 15. Year 4, 2 over 15. And year 5, 1 over 15. Each year, you multiply this percentage with the original cost of the item. Jim's Trucking has been in business for 5 years. They contract with a small grocery store chain to deliver inventory to local grocery stores. They would like to expand within a year and get a few more contracts with other small grocery store chains. Another loftier goal of Jim's Trucking is to own 10 big rigs and start delivering inventory for one of the largest grocery store chains in the Midwest. However, the owner believes it may take 5 to 7 years to achieve this goal. We can categorize Jim's Trucking goals as short and long term. The short-term goal is to obtain a few more contracts within a year, and the long-term goal is wanting to deliver inventory for the largest grocery store chain in 5 to 7 years. Just as Jim's Trucking has short and long-term goals to bring in more sales, there are also bills they will owe now, and some that will be due later as they build their business. These bills are called liabilities. Liabilities are obligations that a business owes and are categorized as current and long-term. Current liabilities are obligations that are due within a year, while long-term liabilities come due in more than a year. For the rest of this lesson, we will discuss current and long-term liabilities and how they are categorized. We'll also provide examples and determine on which financial statement you can find these types of liabilities. Current liabilities are obligations a business owes within a year. You can find these obligations on the balance sheet in the order in which they are due. Can you think of any current liabilities Jim's Trucking may have in the short term? Jim has employees who need to be paid every 2 weeks. On the balance sheet, we would total the amount due for a year and label it as salaries payable. Another example of current liability would be taxes. Most taxes are due within a year. Therefore, sales tax they've collected from customers must be sent to the state taxing agency, and federal tax they may not have yet paid to the federal government should also be listed. Jim's Trucking may also have an account for office supplies. These supplies are purchased on credit. Credit is when a business allows its customers to take possession of the items and pay for them later. This would be considered an accounts payable on the balance sheet. A small dollar amount of accounts payable would typically be paid within a year. Now let's look at their long-term liabilities. Long-term liabilities are obligations that will come due after a year. They are also listed on the balance sheet after the current liabilities section. Jim's Trucking's long-term liabilities can include their big rigs. These 18-wheelers are expensive. They can cost over $100,000, and payments certainly can last for more than a year, sometimes 5 to 7 years. These truck payments are noted on the balance sheet as truck loans. Other long-term liabilities include payments on a building the trucking company is purchasing from the bank, which should be shown as a mortgage loan. Another long-term liability for Jim's Trucking could be a long-term loan to help finance truck repairs. These payments are due monthly, but the total loan may not be due for a few years. This type of loan would be listed as notes payable. It's important for a business to understand who they owe now and later, hence the importance of categorizing liabilities as current and long-term. Liabilities are obligations that are owed and can be found on the balance sheet. Current liabilities represent obligations that are due within a year. Examples include salaries and accounts payable. Accounts payable are small credit accounts where a business has allowed a customer to take possession of supplies or other items for a monthly payment, and usually require full repayment of the total within a year. Long-term liabilities are obligations that will be paid in more than a year. For example, Jim's Trucking's car and truck loans may last for 5 to 7 years. Long-term liabilities can also include a mortgage loan, where a business is making payments toward owning a building, which can last 15 to 30 years. A last example of a long-term liability is a long-term loan, where a business borrows money from a bank and agrees to pay the money back in longer than a year, depending on the size of the loan and payments.
Sam is interested in starting a computer repair business. He talks to a loan officer about borrowing money to start the business. The loan officer tells Sam he needs to provide a balance sheet of the known assets and liabilities. Sam tells the loan officer he's familiar with known assets, which are owned items with a specific value, but he's unclear about known liabilities. The loan officer starts by defining liabilities, which are obligations the business will owe. Known liabilities are liabilities that have a specific dollar amount that he will need to pay. These types of liabilities are created by agreement, contract, or law. For the remainder of this lesson, we'll explain which financial statement you'll find known liabilities listed on. You'll also learn about the three categorizations of known liabilities: agreement, contract, and law, and we'll discuss examples of each. Liabilities are obligations that are owed. These obligations are found on the balance sheet and are created by agreement, contract, or law. Let's first look at liabilities by agreement. A liability by agreement is an arrangement between two or more parties that is not enforceable by law. For example, let's say Sam's computer repair decides to partner with another computer repair shop to fix more complicated repairs brought in by their customers. Rather than turn those customers away, Sam's will take in the item and then send it to the other shop for repair. Sam and the computer repair shop casually make an agreement. They do not have any specific terms on the time frame for repair or payment. Once the other computer repair shop fixes the item, they call Sam and tell him how much he owes, which creates a liability by agreement. You will see this type of liability listed on the balance sheet as an accounts payable. Now, let's look at a known liability by contract. Another type of known liability is a liability by contract. For example, Sam would like to start selling new computers to customers whose computer cannot be fixed. Sam contacts a computer manufacturer. The computer manufacturer gives Sam a contract to review their terms. Sam signs the contract and thanks them for the approval. Being able to sell new computers will definitely increase his sales. Once Sam purchases computer systems and starts receiving bills, an obligation or liability by contract has been created. Sam is expected to pay the bill based on the terms of the legally binding contract. This type of liability is also listed as an accounts payable. The loan Sam requests from the bank is also considered a liability by contract, since there are terms Sam must legally abide by. This type of liability is listed as a notes payable. Let's review the last type of liability, liabilities created by law. Businesses are required by law or regulation to pay certain types of taxes. Can you think of two types of taxes Sam might owe? If you guessed sales tax, you're right. Sales tax is a tax imposed on the buyer that the seller must collect and send to the state tax collecting agency. Since this tax is not sent daily, but usually monthly or more commonly quarterly, the amount due creates a sales tax liability line item on the balance sheet. Another type of liability created by law is a federal tax liability. If Sam makes enough profit, he will be required to pay a portion of profit in taxes. For example, let's say Sam's accountant prepares the business taxes on January 1st, but the tax return and payment is not due until April 15th. If a monthly balance sheet is constructed for the month of February, it will list the taxes owed as a federal tax liability on the balance sheet. Liabilities are obligations owed by a business and can be found on a balance sheet. There are three ways liabilities can be created: by agreement, contract, or law. Liabilities by agreement are obligations owed by an agreement between two or more parties, but not enforceable by law. In the above example, Sam agrees to pay another computer repair store to perform more complicated repairs. This type of liability is categorized as an accounts payable. Another type of liability is one created by a contract. Sam obtaining a loan from the bank is an example of a liability by contract, otherwise known as a notes payable. This type of liability has enforceable terms and conditions. The last type of liability is an obligation created by law. An example of a liability created by law is a tax. We discussed two types, sales tax and federal tax. In sum, known liabilities are obligations with a specific amount that a business is aware they need to pay.
And landed her Jan just graduated from college and landed her dream job as a junior accountant at ABC Technology Corporation. Her first project is to create financial statements. She starts with the balance sheet and completes each line item accurately except for retirement, warranties, and property taxes. She leaves those blank because she's unsure of the dollar amounts. When she meets with her boss, she shows how she completed the balance sheet except for 3 line items. Her boss asks, "Why did you leave these 3 lines blank?" Jane replies, "Because we do not know the exact dollar amounts."
Her boss says adamantly, liabilities are obligations that we owe. We must include all the liabilities to show an accurate balance sheet. Retirement, warranties, and property taxes are what we call estimated liabilities, and even though we don't know their actual totals, we must provide our best guess. For the remainder of this lesson, we'll explain the most widely known estimated liabilities: retirement, warranties, and property taxes. You'll also learn how to estimate these types of liabilities. Liabilities are obligations that are owed, and while most liability amounts are known, there are some Jan will need to estimate to complete the balance sheet. ABC Technology Firm has been in business over 50 years. The company has hundreds of employees who have retired with a pension. A pension is a retirement plan where the employee, during their working career, has a percentage of their paycheck deducted for retirement. Once they retire, they receive a monthly check for life. These monthly payments must be included on the balance sheet as a liability. The current retiree payments are easy to calculate as liabilities because they're already being paid and we know the exact dollar amount. However, there may be employees retiring this month, which will need to be estimated to accurately calculate retirement liabilities. Jan decides to go to ABC's Human Resource Department to determine who's eligible to retire this month. Based on the number of people eligible and their pension benefits, she will add this number to retirement liabilities to reflect the most current available information. At best, her calculations may be overestimated since some employees who are eligible to retire may not. Now she needs to tackle warranties. ABC is a well-respected company. They claim to have the best employees, manufacturing plants, and the most innovative, reliable products. Their motto is, "If it breaks, we'll replace." They are so confident in their products that they offer a 5-year warranty. A warranty is a promise to repair or replace a damaged part or product. To estimate warranties, Jan pulls last year's financial statements and finds sales and warranties. She finds sales of $1 million and warranties of $100,000. Jan takes $100,000 of warranties and divides it by $1 million in sales to derive at 10%. Therefore, warranties are typically 10% of sales. Jan finds the current sales and multiplies that number by 10% to estimate warranties. Her next task is to estimate property taxes. Property taxes are taxes a business owes on property it owns. ABC's properties include commercial buildings, trucks, and inventory. The local taxing agency applies a percent to the market value of the property to get property tax liabilities. Jan knows there's been a change in the market value of ABC's property since the last balance sheet was created. She also read the property tax percentages may go up, so she accesses the tax agency's website to see that they have in fact increased. Therefore, Jan estimates the new market value of ABC's property and applies the new property tax percentages to come up with estimated property tax liabilities. Now, her balance sheet is complete with the most current, accurate information available. Liabilities are obligations a business owes. While most liability amounts are known, there are some that need to be estimated, such as retirement, warranties, and property taxes. Retirement liabilities are monies owed to people who have worked for a company but are now retired. They will need to be estimated to include employees who are eligible to retire. Warranties are promises to repair or replace broken or damaged parts or products. Since a company is unsure how many warranty claims they may receive, an appropriate estimate is required to calculate accurate warranty liabilities. Lastly, property taxes are also considered an estimated liability. Property taxes are taxes a business owes on their property based on the property's market value and the tax percentages the agency will apply. Since one or both of these factors can change, property taxes should be estimated to provide a more accurate picture of the amount owed.
Bob just landed his dream job as an auditor for the largest accounting firm in the United States. One of his job responsibilities will be reviewing company financial statements to make sure the calculations are accurate and all important information has been disclosed. The accounting firm sent Bob to audit the financial statements of Ocean World Amusement Park. Bob starts by speaking with the executives and reviewing the balance sheet. Bob specifically focuses on the liabilities section of the balance sheet. Liabilities are obligations owed by the amusement park. In his conversation with the executives, they told Bob there may be a product recall on rabbit ears they manufactured this year. In addition to the recall, a lawsuit is pending against the company, and legislation may change regarding health care for employees. Bob tells the executives that these situations are considered contingent liabilities. Contingent liabilities are possible obligations the company may owe. Based on their probabilities of occurring, they may need to be estimated and added to the financial statements. For the remainder of this lesson, we'll explore 3 types of contingent liabilities: product recall, lawsuits, and changes in legislation. You'll also learn where this information should be reported on the balance sheet. As Bob continues to explain contingent liabilities to the executives, he reviews the balance sheet to see where they are reported. Bob asks the executives, "Where are these situations you just mentioned on the balance sheet?" The executives tell Bob since they have not occurred, they did not list them. Bob tells the executives that if the contingencies have a high probability of occurring, they must list them as a footnote on the balance sheet to provide more of an accurate statement of possible future obligations. The executives look confused. Bob says, "Let's take the product recall as an example, but first tell me what happened." The executives explained to Bob that they manufactured and sold battery-operated bunny ears for kids to purchase and wear at the park. As the kids wore the bunny ears and the day got hotter, the bunny ears overheated and caught fire. Some of the kids' hair was singed, but no serious injuries occurred. As a result of several bunny ears catching fire, the executives were seriously thinking about recalling the bunny ears and giving everyone their money back. Bob explained to them if they anticipated recalling the bunny ears, they would need to estimate how many refunds they would give and note that dollar amount on the balance sheet. He then asked about the pending lawsuit. After Bob clarified how the amusement park needs to account for the possible product recall, he asked them about the pending lawsuit. The executives explained to Bob that the amusement park was being sued by some of the parents whose kids' hair got singed by the bunny ears catching on fire. Bob asked them to bring in their attorney to discuss the probability of the amusement park losing the lawsuit. The attorney walked in the room and told Bob that they were more than likely going to lose the lawsuit and would need to pay the parents millions of dollars. Bob told the executives since there was such a high probability of loss, they would need to include this information on the balance sheet also as a footnote. Now for the change in legislation. Bob asks, "What is that about?" The executives explained to Bob that federal law may mandate that all employers provide health insurance to their employees. The executives all agreed health insurance was important and wanted each and every employee to be covered. However, the cost to the company would be astronomical. Bob asks his typical question again. Is there a possibility this legislation will pass? Do you think employers will be required to provide health insurance coverage to all employees? The executives all agreed. They believed the legislation would pass. Bob said, "Well then, you must estimate the cost and include it as a footnote on the balance sheet." Liabilities are obligations a company owes. Contingent liabilities are obligations a company may possibly owe. As resounded above, Bob told the executives, if there's a high probability the liability will occur, then it needs to be footnoted on the balance sheet to provide an accurate picture of their future liabilities. In this lesson, we discussed 3 types of contingent liabilities: product recalls, pending lawsuits, and changes in legislation. Liabilities with a high probability of occurring need to be accurately estimated and added as a note on the balance sheet.
Dan is a senior at the University of Financial Management. He's enrolled in Accounting 3 and his first day of class starts in 2 weeks. The professor has given the class a summer project due the first day of fall classes. Dan's a little apprehensive about the project because he's unfamiliar with the topic, measuring long-term liabilities and annuities. Dan knows long-term liabilities are obligations owed for more than a year. He also remembers an annuity represents a series of payments. However, he's unclear about the correlation between the two and how to measure them. Dan decides to schedule a tutoring session to learn more about the subject. For the rest of this lesson, we'll explore examples of a long-term liability and an annuity and discuss how they are measured. Liabilities are categorized on the balance sheet as current or long-term. Current means the obligation will be paid within a year. Long-term, on the other hand, means obligations take more than a year to pay. Examples of long-term liabilities are a mortgage on a building, which usually has a term of 15 to 30 years, and a company car loan, which usually has a term of 3 to 5 years. These types of liabilities are easy to calculate and are spelled out in a loan contract. To measure long-term liabilities, we simply find the balance, which is the difference between the dollar amount of payments we've made and remaining principal and interest. Principal is the amount borrowed, and interest is the cost associated with borrowing the money. The balance is listed on our statement from the financial institution, and if we're constructing a balance sheet, we use that dollar figure as our remaining long-term liability. Now that we've discussed examples of long-term liabilities and how they are measured, let's discuss annuities. An example of an annuity is a bond. A bond is similar to an IOU. Let's say your neighbor wants to borrow $1,000 and will pay you 10% interest until he pays you back in 5 years. You think that's a pretty good deal, so you agree to the terms. Each of the 5 years, your neighbor pays you $100, $1,000 times 10% interest. Then, at the end of year 5, your neighbor pays you the $1,000 back. In financial terms, the $1,000 is considered the principal and $100 is interest. Now, from a corporate perspective, when a company wants to expand and grow, invest in research and develop, or create a new product, they may issue bonds to investors. Investors purchase the bonds with a promise to receive periodic, regular interest payments and the principal at maturity. The reason why it's considered a liability for the corporation is because it's a long-term obligation they owe to the investor. In order to determine how much investors will pay for a bond, the corporation estimates how much the bond is worth by calculating the present value. In simple terms, the present value is the value of a bond now, in present time, discounted by an interest rate. Let's look at an example. Let's say BQB Corporation wants to issue a $100,000 of bonds and pay coupon interest of $9,000 annually with an 11% interest rate due in 5 years. What will buyers pay for this bond issue? To find out how much the bonds are worth, we must calculate the present value of an annuity. There are several ways to calculate the present value of an annuity: manually, by a financial calculator, spreadsheet, or online calculator. To calculate manually, we need financial tables. These are found in the back of an accounting or finance textbook or online. The financial tables show a 3-digit decimal that allows us to discount a number to the present value based on the bond's interest rate and maturity, or number of years. Below is the present value of $1 table. Based on the bond above, find 11% in the column and 5 periods in the row. Where they intersect, we have a factor of 0.593. We multiply 0.593 times $100,000 to derive at $59,300. Thus, $100,000 discounted 5 years to the present is $59,300. Step 2 of this calculation is to find the present value of the coupon interest payments. We need to access the present value of an annuity table. An annuity is a series of payments, and since we'll receive the coupon interest payments annually for 5 years, we need to use the present value of an annuity table to discount these payments to the present value. You will use 11% at 5 periods to find a factor of 3.69 and multiply the factor times $9,000. Therefore, the present value of $9,000 of payments for 5 years is $33,210. Add the present value of the principal to the present value of the coupon interest payments to derive at the current price of $92,510, $59,300 plus $33,210. This is how much the investors would be willing to pay for this bond, and as a result, when constructing a balance sheet, we would list this figure under bonds payable. Long-term liabilities are obligations owed for more than a year. Examples of long-term liabilities are a mortgage or car loan. These are pretty easy to calculate since we must pay back the principal, the amount borrowed, and the cost associated with borrowing the money, which is considered interest. Bonds are also long-term liabilities. Bonds are considered an IOU and are issued when corporations want to expand and grow. Bonds are also considered an annuity because the corporation must pay a series of regular payments to the investor. Before they announce the dollar amount of the bond issue, the corporation calculates the present value of the bond to determine how much investors would be willing to pay today. To find the present value, we use financial tables and discount the principal using the present value of $1 table and discount the annuity by using the present value of an annuity table.
Jan just graduated from the University of Pacific and has landed her dream job. She meets with her boss on the first day, and he asks her if she could give a presentation on long-term liabilities to the summer interns. Of course, Jan agrees, but she feels a little uneasy about what to present. She remembers long-term liabilities are obligations owed by a company for more than a year. However, beyond that, she's a little rusty. She decides to visit her former college professor for some help. He tells her she should include in her presentation some of the more purposeful long-term liabilities such as bonds, pensions, long-term leases, and mortgages. This jogs Jan's memory, and she starts preparing for the seminar. For the rest of this lesson, we'll explore how to account for bonds, pensions, long-term leases, and mortgages. When a company wants to create a new product line, expand their operations, or invest in another geographical area, they have three main financing options. Take a loan from a financial institution, sell stock, or sell bonds. A bond is similar to an IOU or loan. The company issues bonds and investors purchase those bonds with a promise of repayment years in the future. What makes a bond attractive to the investor is that they receive periodic payments until the full amount is paid back. The amount the company borrowed is called the principal, and the periodic annual payments made to the investor are called interest payments. When an investor purchases the bond at a value less than the principal, the bond is considered sold at a discount. For example, if the bond's purchase price is $100,000, but the principal amount to be repaid is $125,000, then the investor purchased the bond at a discount. However, if the bond purchase price is $150,000, but the principal amount to be repaid is $135,000, the investor purchased the bond at a premium. In sum, premium means purchasing the bond at a greater value than the principal. Why would an investor purchase a bond for less than it's worth? Remember, investors receive annual interest payments. Sometimes these payments can total more than the loss of principal once the bond matures and can result in a substantial net profit for the investor. Regardless of whether the investor purchases the bond at a premium or discount, the company issuing the bond must carry the principal, the amount to be repaid as a long-term liability on the balance sheet. Now let's define pension and see how they are accounted for. A pension is an arrangement whereby an employer provides lifetime payments to an employee after they retire. While the employee is working, the employer deducts a percentage of the employee's paycheck and has the amounts invested in a pension fund. Although the explanation of a pension sounds simple, it's a complicated process, and there are many important factors to consider when accounting for pensions. One factor is called vesting. In order for an employee to be eligible for pension benefits, they must be vested. Vesting requires a certain number of service years before the employee is entitled to pension benefits. The vested benefits are listed as a long-term liability on the balance sheet. Pensions also have associated expenses such as the cost of maintaining the pension plans. So, be careful not to include those as a long-term liability on the balance sheet. Remember, expenses are the cost of doing business and should be reported on the income statement. Now, let's move on to long-term leases. When companies want to purchase expensive equipment, they often calculate the benefits of purchasing the equipment versus leasing. While there are advantages and disadvantages of both, we'll explore two types of leases and discuss how to account for them. Leasing provides a contractual arrangement between the company and the lessor that gives the company the right to use the equipment in exchange for periodic payments for a specific period of time. There are two types of leases, capital and operating. It's important for you to know the difference as they are reported differently from an accounting perspective. Capital leases are where the company retains the equipment after the lease ends. In essence, it's similar to a rent-to-own concept. The equipment is an asset, an item owned by the company, and the lease payments are a liability, an obligation owed. Both are listed on the balance sheet. The next type of lease is an operating lease. An operating lease is where the lessor keeps the equipment after the lease ends, meaning the company uses the equipment for a specific period of time, and after the lease ends, they have no ownership rights. Operating lease payments are listed as an expense on the income statement. Now, let's move on to another type of long-term liability. When a company wants to purchase a building, they typically do not pay cash. They seek a mortgage loan from a financial institution. Since the mortgage loan is an obligation owed, it's listed on the balance sheet as a liability. Liabilities are categorized as current and long-term. Current represents the mortgage payments that will be paid within a year, while long-term are payments that will be paid after that year, essentially the balance of the loan. Long-term liabilities are obligations owed by a company for more than a year. Examples of long-term liabilities are bonds, pensions, long-term leases, and mortgages. A bond is similar to an IOU. The company issues bonds and investors purchase those bonds with a promise of repayment years in the future. The amount the company borrowed is called the principal, and the periodic annual payments made to the investor are called interest payments. When an investor purchases the bond at a value less than the principal, the bond is considered sold at a discount. Bonds can also be purchased at a premium, purchasing the bond at a greater value than the principal. Remember, the interest payments can more than make up for the loss in principal. Nevertheless, bonds must be listed on the balance sheet as a long-term liability. A pension is an arrangement whereby an employer provides lifetime payments to an employee after they retire. Vesting is an important component as it relates to listing the benefit as a liability. Vesting requires a certain number of service years before the employee is entitled to pension benefits. Those vested benefits are listed on the balance sheet as a long-term liability. Leasing provides a company the right to use equipment. There are types of leases which have different accounting treatments. Capital leases are where the company retains the equipment after the lease ends. The equipment is listed as an asset and the payments are listed as a liability. On the other hand, an operating lease is where the lessor keeps the equipment after the lease ends, and those payments are listed as an expense on the income statement. Lastly, there are mortgage loans, where the company has borrowed money for a building. Mortgage loans are long-term in nature. However, the payments due within a year should be listed in the current liability section of the balance sheet.
Bonds, much like relationships, come in many varieties. Learning about the different types of bonds is a lot like searching for a mate. There are different characteristics that we want out of someone we form a relationship with. In the case of a bond, there are certain parameters that both the issuer and bondholder want to have in place to protect their interests within the bondholder-issuer relationship. This lesson will teach you about some of the more common types of bonds and their characteristics, using relationships as an analogy. Are you all in? And do you have anything to lose if you break up? How invested are you in this relationship? The first set of matchmaking criteria that we will talk about is security. We want to know how much you invest yourself in a relationship. Will the bond that you form together be one that is secured and backed by some type of tangible asset, such as a ring, house, car, etc.? Or are you the type that wants your mate to be happy with your mere expression of loyalty being enough to sustain the relationship? Let's look at a bit more into the idea of security and bonds. Secure bonds use collateral to financially safeguard the bondholder against the issuer's default. This collateral protects both the interest due on the bond as well as the principal balance. If at any time the issuer fails to pay the par value of the loan or the accrued interest, the bondholder will request for the collateral to be sold so that the profits can be put towards the bond debt. Unsecured bonds, also called debentures, use the issuer's general credit rating to back the bond. The issuer must have a strong financial background to be in a position to issue bonds with a satisfactory interest rate that will attract investors. In other words, the bondholder is relying on the issuer's promise and good word to repay the bond. This lack of tangible assets to support the unsecured bond makes them more risky than a secured bond. However, while riskier, it also equates to a higher potential yield, since risk and yield go hand in hand in the financial markets. The next set of criteria to look at has to do with your level of commitment. Are you someone that is ready to commit to a date to get married, or are you the person who wants to think about it and build your relationship over time? Are you a long-term lover or a serial dater? Here is what this looks like in bond terminology. Term bonds mature or become due on one specific date. It is a date that both the issuer and bondholder commit to, whereby each party knows when the bond relationship will be terminated. The par value of the bond is paid and the bond is returned to the issuer. Serial bonds are bonds in which a portion of the outstanding bonds matures or become due at several dates, which typically fall in a series. Serial bonds allow the issuer to make several staggered payments toward the par value of the bond over the life of the bond. The serial bond is often used to finance a project while providing predictable and steady income streams. Now let's talk about titles. Are you the person who wants to go steady and have the title of girlfriend, boyfriend, or husband, wife? Or are you just satisfied being together that you prefer not to make it Facebook official? Let's see how bonds do it. Registered bonds are issued in the names and addresses of their holders. The bond issuer will then make payments to whoever is the registered holder. The registered bond demonstrates ownership with a title. Bearer bonds are payable to whoever bears or holds the bond, rather than having a registered owner. This can be a risky way to go because anyone could claim ownership of the bond as long as he or she bears it. Because of the risk associated with bearer bonds, very few are in circulation today. Finders keepers, losers weepers is not a fun game to play when it comes to money. Much like relationships, both convertible and callable bonds have an uncertain lifespan. People grow apart, find inexcusable differences, and go their separate ways. It is the desire by both parties to either continue or terminate the relationship. A bond that is either convertible or callable has those same provisions to discontinue the bond relationship. In the case of the convertible bond, the bondholder has the right to terminate the bond before the stated maturity date, while the issuer has that same right with callable bonds. Here's how. Convertible bonds provide the bondholder the right to exchange the bond for a specific number of shares in the company's common stock before the maturity date. The potential exists for the bondholder to benefit from increased stock market value of that stock. The profit potential is unlimited. Callable bonds allow the issuer the opportunity to retire or pay off a bond at a stated dollar amount before reaching maturity. The bondholder must return the bond to the issuer, who will then pay a predetermined amount for the bond, usually the face value of the bond, together with accrued interest to date. Let's review. Bonds come in many varieties. In this lesson, you learned about some of the more common types of bonds and their characteristics, including secured bonds use collateral to financially safeguard the bondholder against the issuer's default. Unsecured bonds, also called debentures, use the issuer's general credit rating to back the bond. Term bonds mature or become due on one specific date. Serial bonds are bonds in which a portion of the outstanding bonds matures or becomes due at several dates, which typically fall in a series. Registered bonds are issued in the names and addresses of their holders. Bearer bonds are payable to whoever bears or holds the bond, rather than having a registered owner. Convertible bonds provide the bondholder with the right to exchange the bond for a specific number of shares in the company's common stock before the maturity date. Callable bonds allow the issuer the opportunity to retire a bond at a stated dollar amount before reaching maturity. Sally Sweets has dreamed of sharing her passion for baking with the world ever since she got her first Easy Bake Oven. At only 10 years old, she knew that she wanted to open a bakery where she could spend her days in chocolate, cookie, and custard heaven. After spending many years dreaming, she was ready to make her dream a reality. In order for Sally Sweets to begin building her bakery, she first had to figure out how she's going to pay for it. As a recent college grad, Sally Sweets lacks the collateral to fund it herself, so she needs to explore her options. Sally Sweets quickly discovered a great way to fund this large project was through bond issuances, whereby the company sells bonds to an investor for a specific dollar amount and interest rate for a predetermined length of time. A bond is basically an IOU issued by a company, in this case Sally Sweets Bakery, and purchased by an investor for cash with interest. Essentially, the borrower, Sally Sweets, agrees to pay whatever amount of money she borrows, let's say $50,000, plus interest. The initial amount borrowed, the $50,000, is also known as the par value of a bond, face value, or face amount, and is paid back by the borrower at a specific date in the future, known as the bond's maturity date. It is on this maturity date that the bond issuer must pay back the principal balance of the bond. The interest earned over the length of the bond, for example 20 years, is typically paid by the borrower in semi-annual payments, every 6 months, to whoever issued the bond. This interest payment, known as a coupon, is received by the bondholder during the time between bond issuance and maturity. Here are the specifics of Sally Sweets' bond. Par value of the bond equals $50,000. The interest rate is 10%. The coupon amount is $5,000 annually, or $2,500 every 6 months. The maturity date is 20 years from the date the bond was issued. And the total amount Sally Sweets will pay back is $150,000, $100,000 in interest, $50,000 par value. There are 3 main advantages of bond financing for those issuing the bond that I like to call money, power, and tax deduction. Money refers to the first advantage of how bonds can increase return on equity through a process called financial leverage or trading on equity. These 2 terms refer to degree to which a company is utilizing borrowed money. When a company is able to use borrowed money to help them make more money than they have to pay for borrowing that money, i.e. interest payments, it will have increased its return on equity. For example, let's say that by borrowing the $50,000, Sally Sweets was able to open her bakery, which yielded $150,000 profit in her first year. Because she only paid $5,000 during that year in interest, she will have had a high return on equity. Of course, if Sally Sweets Bakery experiences a period of low income or net losses and earns a lower return with the borrowed funds than it pays in interest, it would decrease its return on equity. Power, or more specifically control, is the second advantage of bond financing. Because bonds do not affect owner control, such as in the case with equity financing, Sally Sweets will not have to surrender any ownership rights for her company to the investor. The investor earns interest plus the par value of the bond when it matures, and nothing more. The final advantage of bond financing is tax deduction, or the ability to deduct the interest payments of the bond. Therefore, the annual interest payment of $5,000 will be deductible on Sally's U.S. income tax return. This is in contrast to dividends from common stock, which are not tax deductible. Let's review. Bond issuances are a great way for companies to fund large projects. A bond is an IOU issued by a company and purchased by an investor for cash with interest. The initial amount borrowed is also known as the par value of a bond, face value, or face amount, and is paid back by the borrower at a specific date in the future, known as the bond's maturity date. The interest earned over the length of the bond is typically paid by the borrower in semi-annual payments to the lender who issued the bond. This interest payment is known as a coupon. There are 3 main advantages of bond financing, which include bonds can increase return on equity if the company who issues a bond makes more money as a result of having those borrowed funds than it pays in interest. Bonds do not affect owner control, so that the issuer will not have to surrender any ownership rights for company to the investor. And the interest of bonds is tax deductible on the issuer's U.S. income tax return.
Bob has owned a technology firm for 10 years. The business has done very well, and now he wants to expand and invest in more research and development to offer more product lines. When a company wants to expand and grow, they have 3 options to finance the expansion: sell stock, seek a loan from a financial institution, and sell bonds. Bob's firm has several outstanding loans, and he's already spoken with an investment banker about selling stock. Now he's interested in issuing bonds. He makes another appointment with the investment banker to discuss selling bonds. The investment banker explains to him that a bond is similar to an IOU, where investors loan the technology firm money with the expectation of annual interest payments and repayment at maturity. He also says that the initial price of the bond issue would be determined by 3 factors: demand, risk, and market conditions. For the rest of this lesson, we'll examine how these factors affect the initial price of the bond. Demand represents how interested investors are in the company. If Bob's firm is on the cutting edge of technology and in the process of developing the most technologically advanced widgets, then investors may be interested. However, if Bob's firm has an idea to bring back the analog TV era, then there may be little interest in his company. Let's say Bob's firm is in the process of developing the world's most advanced widget, and investors are lining up to purchase the bonds. With the help of the investment banker, Bob decides he will issue $100,000 bonds with $9,000 as the annual payment payable to the investor for 5 years. At the end of the 5th year, Bob's firm will pay the $100,000 back. In this instance, $100,000 represents the principal, $9,000 are the annual coupon payments, and 5 years are considered the maturity date. Based on demand and other factors which we'll discuss later, the bonds can sell at discount or a premium. If the bonds sell at a discount, the investors will purchase the bonds at a price less than the principal. For example, they may purchase the bonds at $98,000. In year 1 through 5, they'll receive $9,000 each year, and at the end of the 5th year, they'll receive the profit of $2,000, $100,000 minus $98,000. For purchasing the bond, they'll receive $47,000, $2,000 in profit plus 5 years times $9,000 in total. Now, what if the bonds are in great demand and investors are willing to pay $125,000 for the bonds? Keep in mind that they'll only receive $100,000 of principal at maturity. These bonds are being sold at a premium, which means bonds are sold at a price greater than the principal. Why would an investor lose money on the principal? Good question. Remember the interest payments? Typically, the coupon payments will be higher when bonds are sold at a premium. For example, let's say the firm will issue $100,000 bonds with $15,000 annual coupon payments and 5 years to maturity. While we know the investor will lose $25,000 from the principal, $100,000 minus $125,000, they will make $75,000, or $15,000 times 5, in coupon payments for a net profit of $50,000, $75,000 minus $25,000. Now let's look at another factor of the price, which is risk. Risk is the chance of financial loss. Investors know there's a possibility of losing money when they invest. However, investors have different risk tolerances. Some are willing to lose a lot of money. We call these investors risk tolerant, while others are considered risk averse, meaning they do not want to lose very much money, if any. In order to assess a bond's risk level, bond ratings are assigned based on the company's financial health. Bond ratings are similar to school grades. An A is excellent, B is good, C represents average, and D needs improvement. An A-rated bond would be considered a good, low-risk investment, and a D-rated bond would be considered high risk. A bond that carries a rating lower than BB by Standard & Poor's or lower than BA by Moody's is called a junk bond. Remember, there's a correlation between risk and return. The higher the risk, the higher the return. Therefore, investors who purchase a D-rated bond would have a much higher annual coupon payment than those who purchased an A-rated bond. They also would most likely purchase the bond at a discount. The next factor that affects price are market interest rates. Market conditions refer to the financial state of our economy. There are many factors that affect our economy, and the analysis is extremely complicated. However, in the investment world, we can classify market conditions as bull or bear. A bull market signifies a buying market where investors are interested in purchasing bonds and few are willing to sell. Therefore, if we apply the concept of supply and demand, we know that when supply is low and demand is high, the price increases. Conversely, in a bear market, investors are willing to sell rather than buy. A bond is similar to an IOU, where investors loan the technology firm money with the expectation of annual interest payments and repayment at maturity. There are several factors that affect a bond's price: demand, risk, and market conditions. Demand represents the investor's interest in buying the bond. Based on demand, bonds can sell at a discount, where the purchase price is less than the repayment principal, or bonds can sell at a premium, where the purchase price is more than the repayment principal. Investors are willing to lose money on the principal to receive a large annual coupon payment when buying a bond at premium. The next factor that affects bond prices is risk. Risk is the chance of financial loss. Based on an investor's risk tolerance, they may choose a lower rated bond, which can be considered so risky they're called junk bonds. However, high risk means high return, and investors will look to purchase the bond at a discount. The last factor are market conditions. In a bull market, investors are willing to buy, which may increase the price of the bond. However, in a bear market, investors are more interested in selling, which can have. Monique graduated from college a few years ago and is a manager at Cakes and Bakes Corporation. She has quite a bit of money saved and would like to start investing. She calls one of her college friends who is now a financial advisor. They meet for lunch, and she explains to him that she is interested in investing. Her friend starts by asking what her ideas are about investing. Monique expresses she wants a long-term, safe investment where the risk of losing money is low. The financial advisor tells her those are characteristics similar to a bond. A bond is an investment product where the investor loans a corporation money. In return, the investor would like periodic annual payments and the total amount returned in the future. Based on those annual payments, sometimes an investor is willing to purchase the bond at a discount, an amount less than the borrowed amount, or they may purchase the bond at a premium, an amount greater than the borrowed amount. In this lesson, we'll explain the reason why corporations sell bonds and why bonds are issued at a discount and premium. You'll also learn the advantages and disadvantages of each. A corporation needs money to expand and grow, and typically they have three options: sell stock, receive a loan from a bank, or sell bonds. Bonds are similar to an IOU. The investor loans money to the corporation, and the corporation promises to pay the money back. The amount of money the corporation borrows is considered the principal. While the investor is waiting for the bond to be paid back, which sometimes can take years, they want something in return. Investors require the corporation to pay them interest annually until the principal is paid back. These payments are called coupon interest payments. Interest is the cost of borrowing the money. Let's say a corporation issues bonds of $100,000 with $5,000 coupon interest payments to be paid back in 10 years. The investor knows they will receive $100,000. However, how much should they pay for the bond? The present value is calculated to determine the purchase price. The present value is how much the bond is worth today. The discount arises because the investor can always buy a bond issued today at market interest rates, so this corporate bond must be competitive. If its coupon rate, which is fixed and printed on the face of the bond, is less than market rates, then the investor is offered a discount to get him or her to buy. To simplify this, take the $100,000 times the coupon rate, and then $100,000 times the market rate. The difference is the amount of discount. Let's say an investment broker calculates the present value of the bond at $69,277. Since the present value is less than the future value, $69,277 is less than $100,000, the bond will be sold at a discount. The investor knows they'll make $30,723, $100,000 minus $69,277, plus $50,000 of annual interest payments, $5,000 times 10 years. The financial advisor asks Monique if she understands bonds selling at a discount, and then says, "Now let's look at an example where the future value is less than the present value." Monique asks the financial advisor, why would an investor pay more for the bond than it is actually worth? Sometimes an investor will pay more for a bond than its current value. In essence, the present value of the bond will be greater than the future value, which means the bond is selling at a premium. He or she will pay more or pay a premium when the coupon rate printed on the bond is greater than market rates. They pay more for the bond because he or she will get more interest. You can calculate the premium the same way we did the discount, by taking the face amount of the bond times both market and coupon rates and figuring out the difference. Monique tells the financial advisor that she understands why the company would issue the bonds at a premium or discount, but asks what are advantages and disadvantages of each. The financial advisor explains, clearly issuing a bond at a discount will allow the company to pay smaller annual coupon payments. However, once the bond matures, the investor expects a larger payout of principal. Oppositely, if a company issues a bond at a premium, they're taking in a large sum of money initially, then paying it out over time in higher annual coupon payments. These higher annual coupon payments can be a major challenge when issuing bonds at a premium. A bond is an investment product where the investor loans a corporation money. It's similar to an IOU. If a corporation wants to expand and grow, they can finance the expansion by selling bonds. Essentially, a corporation offers bonds for sale, and an investor purchases those bonds for the benefit of receiving annual interest payments and the repayment of the full amount borrowed at the end of maturity. The amount borrowed is called the principal, while the periodic payments are called coupon interest payments. Interest is the cost of borrowing the money from the investor. A bond can be purchased at a discount, meaning that market rates of interest are greater than the bond's coupon rate. However, sometimes investors pay more for the bond than it will be worth when it matures. This type of bond is purchased at a premium. That means the bond's coupon rate is greater than the rate available in the market. Issuing bonds at a premium and discount can have advantages and disadvantages for the company also. Premium bonds will bring in a significant amount of cash when the bond is sold. However, the company must make sure they have the financial wherewithal to pay the higher annual coupon payments. When bonds are issued at a discount, the company will bring in a smaller amount of cash up front, but make smaller annual coupon interest payments.
Jan is an investment banker at one of the top firms in the country. Her largest client called and asked if she could provide a seminar to newly hired accountants on the retirement of bonds. Jan told her client she would be more than happy to facilitate the seminar. The following week, she starts her presentation by asking, "Does everyone remember how to define a bond?" A few people raised their hand. So, Jan said, a bond is an investment instrument whereby an investor loans a company money in return for periodic interest payments. As accountants, your main function, as it relates to bonds, is to record the retirement of bonds. There are 3 different ways to report the retirement of bonds: at maturity, early retirement at a loss, and early retirement with a gain. For the rest of this lesson, we'll discuss the components of a bond and explore how to report the retirement of bonds based on maturity, a gain, or loss. When a company wants to expand and grow, they have 3 options to finance the expansion: sell stock, receive a loan from a financial institution, or sell bonds. Bonds are similar to an IOU. A bond is a contractual arrangement between a company and investor whereby the investor loans the company money. The loan is considered the principal. The agreed-upon date the bond will be paid back is called the maturity date. Even though the investor will receive the principal back once the bond matures, the company must incur a cost of borrowing the money. The company must pay interest to the investor. Investors expect annual interest payments, called coupon payments, until the bond matures. Let's look at an example. Company XYZ issues bonds for $1,000 with annual coupon interest payments of $150 and a maturity date of 5 years. The bonds will be listed as a long-term liability on the balance sheet. A liability is an obligation the company owes. Most bonds are listed as long-term liabilities since they will be paid back sometime in the future, usually longer than a year. Once the bond reaches maturity, after the 5 years in our example, the bond is retired, and the investors are repaid in full, and the liability is removed from the balance sheet. Now let's see what happens if the bond is retired before the 5-year maturity date. Since bonds are held for quite some time, they have various features to help minimize losses for the issuer. One of those features is called a callable. A callable bond allows the issuer to retire the bond early. Companies sometimes pay off the bond early due to market conditions, investment opportunities, or interest rates. Interest rates are the most common reason why bonds are called in or retired early. Let's look at Company XYZ's bond issuance. They issued $1,000 bonds with $150 annual coupon interest payments, or a coupon interest rate of 15%, $150 divided by $1,000. If a similar bond goes on the market for 7.5% coupon interest rate, or a $75 annual coupon interest payment, the company may call the bond in and retire it, then reissue a new bond at the lower rate of 7.5% coupon interest instead of 15%. When a company retires the bond early, they may pay more than the bond is worth. For example, in year 3, the company decides to call in the bond for $1,200. The journal entry will look like this. The $1,000 debit to bonds payable reduces the bonds payable liability. The $1,200 credit to cash represents payment to the bondholder. The extraordinary loss is the difference. In this case, the company will lose $200, $1,000 minus $1,200, in repaying the principal. The extraordinary loss is reported on the income statement item below the operating section. Even though the company loses a little money on the principal, they save quite a bit on the coupon interest payments. Conversely, if the company has the same outstanding bond of $1,000, but decides to call the bond at $900 in year 3, they will make $100 per bond on the principal and reduce their coupon interest payments. Here are the journal entries. The $1,000 debit to bonds payable reduces the bonds payable liability. The $900 credit to cash represents payment to the bondholder. The extraordinary gain is the difference. It will again go on the income statement below the operating income section. A bond is an investment instrument whereby an investor loans a company money in return for periodic interest payments. Bonds are similar to an IOU. A bond is a contractual arrangement between a company and investor whereby the investor loans the company money. The loan is considered the principal. The agreed-upon date the bond will be paid back is called the maturity date. Even though the investor will receive the principal back once the bond matures, the company must incur a cost of borrowing the money. The company must pay interest to the investor. Investors expect annual interest payments, called coupon payments, until the bond matures. When a bond matures, the liability or obligation owed to the investors has been paid off and is taken off the balance sheet. Bonds also have features to minimize losses for the issuer. Callable is one type of feature that allows the company to retire the bond early. Depending on the market interest rates, the company may retire the bond at a greater price than the principal, or may call the bond for less than the principal. In either case, the gain or loss must be reported on the income statement.
Jan's Upscale Resale is a clothing store that sells gently used ladies' clothing. Jan would like to expand by opening another store. She visits U.S. Bank and Trust to see if she can get a business loan. She meets with Mark, a loan officer at the bank, and submits the business's financial statements. After Mark reviews the information, he tells Jan she's too far in debt to afford a second location. Mark goes on to say there are several ratios that he uses to determine if a business is eligible for financing. One of them is the debt ratio, which shows the percentage of assets financed with debt. The other is the debt service coverage ratio, which measures a company's ability to make their current debt payments. For the remainder of this lesson, you'll learn which financial statement to use to find the line items to calculate the debt ratios and formula. We'll also discuss how to analyze the results. Jan arrogantly tells Mark that her resale store was voted the #1 resale shop in the city. She tells him she has more customers than many regionally owned stores, so it doesn't make sense that she can't get a loan. Mark asks Jan if she has a few minutes so he can explain the debt ratios that he calculated for her business. Jan says, "Of course, let's get started." Mark starts by explaining the components of a balance sheet, which are assets and liabilities. Assets are items owned by her business. Examples include cash, inventory, the building, and cars. Liabilities are obligations she owes. An example could be a loan for the building. Liabilities and the word debt are used interchangeably and mean the same thing. Mark goes on to tell her the debt ratio is calculated by taking total liabilities divided by total assets. Both amounts can be found on the balance sheet. Mark pulls out Jan's business balance sheet and shows her she has total liabilities of $200,000 and total assets of $250,000, which results in a debt ratio of 80%. In sum, 80% of her assets are financed with loans. She still has not paid off the building her store is located in, nor the cars she and her employees drive around the city for business. Mark tells Jan the bank does not make loans to businesses with debt ratios greater than 40%. He suggests she use some of her profit to pay down her debt. Jan asks Mark hastily, "You used one ratio to determine whether to give my business a loan?" Mark replies, "No, ma'am. There is another ratio I calculated that provides more insight. It's called the debt service coverage ratio." Mark tells Jan the debt service coverage ratio is calculated by finding profit divided by debt service. The business income statement shows profit for a specific period, and the balance sheet shows debt service. Debt service refers to principal and interest payments on all loans. Jan asks Mark to explain principal and interest before he talks about the debt service coverage calculation. Mark says, absolutely. When a business requests a loan from the bank will loan the money they requested, which is considered the principal. They'll also charge the business for borrowing money. This is called interest. When a customer repays the loans, which is usually done through monthly payments, they will pay a portion of the principal plus interest in each payment. Mark asks Jan if she understands principal and interest now. She replies, "Yes, thanks for the explanation. Now how did you calculate debt service coverage?" Mark says he found profit on the business income statement of $185,000 and the principal and interest payments of $200,000 on the balance sheet. The result is 0.925, which means there is only enough profit to cover 92.5% of her debt or loan payments. Any calculation less than 1, or 100%, means the business has negative cash flow to cover its loan payments. After Mark explained all of this to Jan, she finally understood why the bank did not offer her a loan, and tells Mark she will spend the next few years paying off business debt rather than trying to expand. In sum, debt, also called liabilities, is the obligations a business owes. When a business wants to get a loan, the bank looks at more than just their ability to make money. They also analyze what they owe and if they're able to make the loan payments. Two main ratios are used for this analysis: debt ratio and debt service coverage ratio. Debt ratio is calculated by taking total liabilities divided by total assets. It shows what percentage of business assets are financed with loans. The higher the ratio, the more the business owes on the assets. The next ratio is the debt service coverage ratio, which is calculated by taking profit divided by debt service costs. Debt service costs are principal and interest payments. The debt service coverage ratio shows how well a business can make their loan payments. A calculation less than 1 shows negative cash flow and the inability to make loan payments.